Assalamualaikum warahmatullahi wabarakatuh. Shalom, Om Swastiastu, Namo Buddhaya, dan Salam Kebajikan. Hello, we are from Group 4 and we will presenting about predictive approach, positive approach, earnings smoothing, and earnings management. Next slide is the group members. Okay, so these are the group members. The predictive approach. The predictive approach arose from the need to solve the complex problem of evaluating alternative methods of accounting measurement. The predictive approach to the formulation of an accounting theory uses the predictive ability criterion, whereby the choice among different accounting options will depend on the ability of the particular methods to predict the events of interest to the user. The predictive ability criterion follows the emphasis placed on relevance as the primary criterion of financial reporting. Relevance has the connotation of concern for information about future events. The predictive approach, according to Biefer and others, the measure with the greatest predictor or predictive power with the respect to a given event is considered to be the best method of the particular purpose. Research based on predictive approach. There are two streams of research. First, that which is concerned with the ability of accounting data to explain and predict economic events, and the second one, that which is concerned with the ability of accounting data to explain and predict market reaction to disclosure. Time series analysis. Time series analysis is a structural methodological approach by which temporal statistical dependencies in a dataset may be examined. Time series analysis research focuses on, first, time series properties of reported earnings, and the second one, prediction issues in time series analysis. Time series properties of reported earnings. Research has examined both reported earnings and models that describe quarterly earnings. First, findings on the annual earnings series present a moving average process, a sub-martingale or on-off-to process, which is martingale and moving average regressive. And the second one, findings on the quarterly earnings series, how that it follows an autogressive process characterized by seasonal and quarter-to-quarter opponents. Predicting future accounting earnings. Sophisticated autogressive process do not forecast significantly better than the random walk method. Models of quarterly earnings have better predictive ability than annual models and books of Jenkins individually identified models. And the last one, disaggregated sales and earnings provide good forecasting ability, but this is not demonstrated for models based on components such as interest expense, depreciation expense, and operating income before depreciation.
The next material are prediction of bond premiums and bond rating. Fisher developed a four-factor model to explain difference in risk premium of industrial corporate bonds. The four factors are: first is earning variability, measured using the coefficient of variation of earning after tax over the past 9 years. Second is solvency or reliability in meeting obligation, measured by the length of time since any of the following last occurred: company establishment, emergency from bankruptcy, and a settlement where creditors received less than 100% of their claims. The third is capital structure, measured by the ratio of marketing value of equity to par value of debt. And the last are total market value of the company's bond, acts as a proxy for marketability risk. The first three variabilities represent different proxies for default risk, while the fourth represents a proxy for marketability risk. Collectively, these four variables explain up to 7,500 of the variation in bond risk premium. The next material are corporate restructuring behavior. Corporate restructuring involves mechanisms such as merger, consolidation, acquisition, divestitures, privatization, leverage buyouts or LBOs, and spin-offs. The main objective of restructuring are to maximize the market value of shareholder equity or maximize management welfare. Research in this area focus on the characteristics of acquired versus non-acquired firms using two analytical approach. First is ex post classification analysis, and the second one is ex ante predictive analysis utilizing univariate and multivariate models. studies highlight the relevancy of accounting ratios in classifying or predicting takeovers, and however, the study face similar limitation of those found in financial distress prediction research. Okay, now I will explain the credit and bank lending decision. Credit evaluation and bank lending decision are other examples of economic event that can be explained and or predict using accounting and financial information. From the predictive approach perspective, research include the application of model to simulate or predict credit evaluation and the prediction of financial condition change as using accounting information. Pathway and Sinke extend this research stream by developing accounting-based classification models. Their findings show that accounting information provides valuable lead time for regulation to fulfill their oversight responsibilities more efficiently. Forecasting financial statement information. Multinational companies or MNC and financial analysis often need to forecast earnings, both of other companies and their own. Forecasting technique may be mechanical or non-mechanical and unvariate or multivariate. So there are mechanical unvariate models are moving average and Box-Jensen unvariate model. Mechanical multivariate models are regression models, Box-Jensen transfer function models, and econometric models. And the last is non-mechanical models are visual curve extrapolation on or univariate and security analysis approach multivariate. This approach helps generate more accurate forecasts of future financial information, including corporate earnings.
Okay, next material is capital market and external accounting. The relationship between capital markets and external accounting relates to how financial information reported by companies, such as income statement, balance sheet, and cash flow statement, is used by investors and analysts in the capital markets to make investment decisions. One way to assess whether an accounting method is effective is to observe the capital market reaction. That is, if an accounting announcement causes a change in stock price or positive or negative, then the information is considered relevant and influential for an investor. For example, if a company releases a hike in earnings reports and its stock price immediately rises, it shows that the earnings are considered important by the market. This approach emphasizes the use of accounting numbers that are most closely related to market price. This means that the accounting method chosen should be able to reflect the value of the company as reflected in the stock price. In other words, if the numbers in the financial statements can predict stock price movement well, then the accounting method is considered more useful and relevant to external users such as investors. Next is evaluation of the market-based research in accounting. The evidence for market-based research is classified into four categories. The first is information content study. This study examines whether the announcement of an event, such as earnings, cause change in the distribution of stock returns. The findings suggest that accounting information, such as unexpected earnings, can affect stock price as the market responds quickly to such information. Two is difference in discretionary accounting technique. The focus is on the impact of difference in accounting techniques on investor decision. The question is the market smart enough to distinguish cosmetic change, which only affect the appearance of financial statement with no real economic impact? Rational investors should not be fooled, but some investors may still react to such difference. Three is consequence of regulation. Certain regulations have been shown to impact investor perceptions, such as business line reporting obligations that affect the risk assessment of multi-product companies. However, some other policies, such as replacement cost reporting or price-adjusted earnings estimate, do not show a meaningful market reaction. Fourth and last is impact on related disciplines. The research also has an impact on other fields, especially in terms of how markets value information. Market value information that is forward-looking and has an impact on cash flow, regardless of how or where it is reported. Therefore, any change in reporting rules should be thoroughly evaluated in terms of its benefit and cost.
So the next material is capital market and accounting information. Some argue the capital market are not efficient handle of accounting information. Connors and Depot argue the stock price association are not sufficient grounds on which to evaluate alternative information system and suggest the need for social welfare consideration. The efficient market hypothesis and empirical evidence supporting it are silent concerning the optimal amount of information. A qualifier has been omitted in the studied sheet in the market efficiency may be implied only if no change in stock price and the firm decision making are observed. Finding out what information is used and should be provided to investor may be difficult. Most of the research cited lacks a theory to predict who should be better or worse off from accounting policy change, and which change, if any, might include change in management behavior to offset the effect of a change in accounting policy.
The positive approach in accounting aims to describe what actually happens in practice rather than discussing what is ideal or should be done. This approach puts more emphasis on observing and explaining accounting behavior in the real world. The main focus is to understand the reason why companies choose certain accounting methods, as well as how these decisions interact with market conditions and interested parties. Some of the theories that form the basis of this approach include agency theory, which explains the relationship between shareholders and managers, emphasizing how financial reporting can help reduce potential conflict of interest by aligning the interests of both parties. The second is contracting theory, which views the firm as a network of contracts among different stakeholders, where accounting plays a critical role in ensuring that agreements are honored and risks are effectively managed. The third is efficient market hypothesis, which suggests that capital markets respond quickly and accurately to new information, including data disclosed in financial reports.
The next material is about the central ideal of the positive approach. The positive accounting approach does not aim to determine what should be done in accounting, but rather focuses on explaining and predicting accounting practices that companies carry out. This is a descriptive and empirical approach, not a normative one. Its main objectives are: the first one is increasing the reliability of prediction. The positive approach wants to make accounting number a reliable predictive tool. This is done by observing the trend of accounting numbers that have been smoothed by management to appear normal and stable. In practice, management often performs income smoothing so that profits appear more consistent over time, so that user of financial statement can predict the company's future with more confidence. The second one is reducing uncertainty and systematic risk. This approach also wants to reduce the uncertainty that arises from large fluctuation in the income statement. By making profits appear more stable, the relationship between the company's stock returns and the market become weaker or low covariance. This means that systematic risk that cannot be discerned anyway because it's related to the entire market, it also reduced. In this context, earning stability can reduce investor risk perception of the company. Next is about the central problem in positive accounting theory. By definition, the key issues in positive accounting theory are explaining and predicting how the choice of accounting policies or procedure affects the economic behavior of the firm, especially in the terms of cash flow and management interests. These approaches does not assess whether the method is good or bad in a normative sense, but rather examines its economic consequence, especially in terms of contractual relationship between the parties in the firm. For example, how do certain accounting practices users, affect the firm's cash flows, and ultimately affects management utility? To answer that question, this approach uses two main theoretical assumptions. The first one, company as a nexus of contracts. This concept views the companies not as a single entity but as a collection of contracts between different parties, such as owners, managers, creditors, employers, and others. Each party has its own interest and the relationship between them is governed by the contract. The second one is the role of accounting information as a monitoring mechanism. Because in the contract here is a potential conflict of interest like agency problem. Accounting information is needed to monitor and enforce the contract. For example, financial statements can be used by shareholders to assess whether managers have managed the company in accordance with the interests of the owners. Thus, accounting is used to reduce agency costs like monitoring costs, incentive, or potential abuse of power by agents or manager.
So that's all the material presented by us. Thank you for your attention and wassalamualaikum warahmatullahi wabarakatuh.